Good morning, everyone, and a very warm welcome to our FRS 102 Beyond Compliance webinar. We have an expert panel here today from Preston Reeves to highlight what the FRS 102 changes mean now that they have come into force and to answer your questions in a Q&A at the end of the session. So I'll just start with some housekeeping, if I may. So this webinar is being recorded and a recording will be sent to you later today. IT permitting, fingers crossed, we'll be asking you a bit of interaction and we'll be taking some polls throughout the webinar and we can share the results with you and generate some further discussion, hopefully. There will be a pop-up survey at the end of our session today and we'd be really grateful if you could just spare a couple of minutes to provide us with some feedback, please. So, without further ado, on to our first poll. So our poll this morning is: how prepared do you feel your organisation is for the FRS 102 changes that are coming up? Oh, people are already coming in. The options are ready, we've started work already, somewhat ready, we're planning it, not ready yet, and not sure. I think not sure is perfectly reasonable. Saying not sure made that increase, which is good. I'm pleased I gave people the confidence to click that button. Okay, so I mean, some people are somewhat ready, but the vast majority, a whopping 69%, have said not ready yet and not sure, and that's perfect because that's why you're here for the webinar today. So we'll get on and give you some information. So, throughout the webinar, please feel free to ask any questions. On the screen now is how to ask questions. We've already had some come in this morning already, but please feel free to click as soon as you think of something. We will get back to everybody who asks a question. I'll leave this on the screen for you to note down how to ask a question, but we'll show you again throughout the webinar. Okay, so over the next couple of years, we will see some of the most significant changes to UK GAAP since FRS 102 was first introduced. In March 2024, the FRC issued a major set of amendments to FRS 102, following its periodic review, with changes applying to accounting periods beginning on or after the 1st of January 2026. Many are now accounting in this period, so the time for preparation has come and almost gone, and is important to consider the practical implications of these changes. At the heart of these amendments, it is clear move towards greater alignment with international standards. In particular, FRS 102 has moved towards IFRS 15 on revenue recognition and IFRS 16 on lease accounting, albeit with simplifications to keep the regime proportionate for UK entities. For many businesses, this will mean fundamental changes to how revenue is recognised, how contracts are analysed, and how leases are reflected on the balance sheet. In some cases, we are also seeing knock-on impacts on key metrics, distributable reserves, banking covenants, and systems and processes. Today's session, our aim is to help you understand what is changing, why it matters to your business, and where the main risks and judgment areas are likely to arise. We will also share some practical observations on what we are seeing in the market and how organisations can approach the transition in a structured and proportionate way. These changes represent a real opportunity to step back, review existing accounting policies, and ensure they remain fit for purpose. We'll have plenty of time for questions at the end, so please do note anything you'd like to explore further and we'll go through them all later. I'm sure you're all keen to get started, so please let me introduce you to today's speakers. Today we are joined by Emily Baldwin. Emily is an accounts director and head of our financial reporting team. Emily has worked at Creston Reeves for over 17 years with extensive experience advising businesses through change and financial reporting. And we are also lucky to be joined by Jack Bradley today. Jack is our Audit Senior Manager and member of our technical team. Jack has years of experience advising our clients and has worked with Creston Reeves for over 15 years. So there is tons of experience on our panel today. So Jack, I believe you're going to start today. So could you set the scene for us? Could you give us a high-level overview of what's changing in FRS 102, when it applies, and what businesses should be thinking about now, please?
Yes, of course. Thank you, Anne, and good morning, everyone. The aim here isn't the detail. We'll cover some of that later on, but I'll start by providing a bit of a framework for today's session. The most important point I want to make up front is this. These changes don't just affect accounting teams. They affect how performance is reported, how balance sheets look, and how decisions made today will feed through into future accounts. So what is changing? At a high level, the amendments fall into three main areas. And yes, I'm afraid we will be talking about revenue and leases again. They've been in all the headlines and there's still good reason for that. So firstly, a reminder on revenue recognition. FRS 102 now adopts a much more structured approach to analysing customer contracts. Instead of asking, can we invoice? The focus is on what has been promised to the customer and when those promises are fulfilled. For some businesses, this will formalise current practice. For others, particularly where contracts bundle goods and services, the timing of revenue recognition may change. Secondly, leases. Almost all leases now come onto the balance sheet. Assets and liabilities increase. Rent expense is replaced by depreciation and interest. And key metrics like EBITDA and debt ratios will change, even though cash payments remain exactly the same. And thirdly, there's a broader package of changes, including fair value measurement, tax accounting, business combinations and disclosures. These don't grab the headlines in the same way, but they still matter for compliance and reporting quality. So when does this apply? Or I should probably say, when did this apply? As mentioned, the revised standard applies to periods beginning on or after the 1st of January 2026. Meaning that many businesses should already be applying these changes to be reported in their next set of financial statements. It's very much a current year issue. Contracts being signed, leases being entered into, and systems that have been designed now will all influence how smooth or painful the transition accounting turns out to be. And what do we really mean by how to comply? Well, when we're talking about compliance here, we're not just talking about getting a set of numbers over the line at the year end. In practice, it really means four things. Firstly, understanding your exposure. That usually means performing an initial impact assessment, looking at representative customer contracts and lease agreements to understand where judgments arise and where numbers might move. Secondly, it's about making early policy and judgment calls. Decisions around transition approaches, contract analysis and lease assumptions drive outcomes. These are not areas that you want to resolve late in the process. Thirdly, we're talking about data, systems and consistency. Many finance systems weren't built with these models in mind. Even where the ultimate numerical impact might be modest, you still need robust data, clear documentation and consistent application across your business. And finally, communication. Profit movements, balance sheet variances, or changes in KPIs may be accounting driven rather than performance driven, particularly in the year of adoption. Boards, lenders, and other stakeholders need to understand that context. So the key message here is this. The revised standard is not something just to deal with at adoption or when putting together the first set of financial statements under the framework. It's something to prepare for. The businesses that navigate this best are those that have started early, understand where the judgment sits, and treat implementation as a structured process rather than a last-minute technical exercise.
Really helpful, Jack. Thank you ever so much. Jack, can I ask, from your technical audit expertise and experience, where are businesses most commonly going wrong as they start to engage with these changes?
It's a good question because the problems we see don't usually come from misunderstanding the rules themselves. They tend to come from how those rules are applied in practice. So with that in mind, I want to keep the focus away from the technical detail again and focus more on what we're actually seeing going wrong and what separates a smooth transition from a painful one. I'll start with two common pitfalls and then touch on a couple of less obvious changes that regularly get missed. So the first of these is assuming this won't really affect us. Probably the most common pitfall we see is the assumption that these changes are only relevant to large or complex businesses. What tends to happen in practice is that companies assume their contracts are simple, their leases are straightforward, or their existing accounting is about right already, which leans to the mindset that this can be dealt with later. A phrase we've heard a lot is, if this is going to affect us materially, we'd have spotted it by now. The problem is that the areas that cause issues are rarely obvious from a headline review. It's usually not the biggest lease or the largest customer contract that creates difficulty. It's the detail around renewal options, bundled promises, or inconsistent treatment across similar arrangements. So a typical example of this might be you review your largest customer contracts and conclude that total revenue hasn't really changed. But you haven't looked closely at things like installation, onboarding, or ongoing support included within those same contracts. Or you might have assumed that similar contracts are being treated consistently, when in practice, different teams or in different years, judgment has been applied or the contract drawn up in a slightly different way. Individually, none of these feel dramatic, but collectively they're exactly the areas that tend to raise questions later on. The second common pitfall is treating this as a finance-only exercise. Another big challenge we see is implementation being treated as something that sits solely within the finance team. Emily's going to talk about this in more detail later, but to put some context to this, we should remember that in reality, sales teams might often control customer promises. Operations teams might manage leases and renewals, and legal teams will draft terms that influence accounting outcomes. Under the revised standard, that disconnect matters more than it used to. For example, finance might view a lease as short-term because that's how it's always been treated. But commercially, the business may fully expect to renew it again and again. The accounting outcome hasn't changed because of an error. It's changed because business intent now matters more, and finance wasn't close enough to that decision. The good news is that this doesn't take large projects to fix. Even light touch cross-team awareness can make a big difference. And now I've got a couple of less obvious but important technical changes. Beyond those behavioural pitfalls, there are some technical challenges easy to underestimate. So firstly, lease completeness rather than lease accounting. Most finance teams we speak to are comfortable, or at least familiar with the concept of lease accounting. The more common challenge is much more basic. Have we actually captured everything that should be considered a lease? This isn't about complex calculations, this is about scope. And if that scope isn't complete, then it can still have a very real balance sheet impact. All businesses should have controls and procedures in place to support both the initial identification of lease arrangements and their ongoing monitoring over time, similar to how you might currently capture capital expenditure for your fixed asset register. Secondly, there's a growing divergence between management and statutory accounts. Another issue that often isn't anticipated is the effect these changes can have on the relationship between management accounts and statutory reporting. Under the revised standard, we're increasingly seeing situations where management accounts continue to reflect historic accounting treatments, while the statutory accounts apply new revenue timing or lease assumptions. And this can lead to differences that can be hard to explain internally. This means that more thought needs to be given about how performance is monitored, explained to boards and compared year on year. So to wrap up this section, let's think about what this means for financial reporting quality. Ultimately, what these changes do is move financial reporting closer to the underlying business decisions being made. High quality reporting under the revised standard is about making sure the accounting reflects how the business actually operates and that the link between the two can be clearly explained. If you're leading a finance function, then that means fewer surprises at the year end, fewer difficult conversations with stakeholders, and a set of accounts that genuinely tell a coherent story about performance and position.
That was really good. Thank you ever so much, Jack. We're going to move on to our next poll, if possible, please. This poll, you can answer as many of the options as you want. Multiple answers allowed. So, what areas are creating the biggest challenge for your business? Technical calculations and application, identifying judgment areas in contracts, transition adjustments and comparative information, systems and data issues, or disclosures and explaining the impact to stakeholders. I mean, I think it's fair to say these are all real concerns, but from the poll, I think it's jumping around, but the top three have come out as the key ones. Transition adjustments, areas of judgment, and technical calculations. So, Jack, you're going to come in very handy, I'm sure, at the Q&A session later. So if I could just remind everybody how to ask questions. If any of what Jack has just said has brought any questions to your mind, please feel free to pop them in the chat. And we will get round to them at the end, hopefully. If not, we'll contact you later with our responses. But maybe I could just hand back now over to Emily. Emily, are there any potentially big changes to the balance sheet and P&L? What does this mean for businesses in terms of borrowing?
Thanks, Anne. Good morning, everyone. So let's think of this in both lease and revenue changes. So for lease changes, this will bring in a right of use asset, but also a liability for the lease at net present value of the lease payments. In turn, the P&L will be impacted with the fact that the lease payments expenses that were often shown as an overhead cost are being replaced by depreciation and interest. So let's convert this into borrowing terminology. So this makes balance sheets look more highly geared, even though cash payments are the same. EBITDA, which is earnings before interest, tax, depreciation and amortization, will improve with the reallocation of the expense. However, interest cover may deteriorate. So for revenue recognition changes, this could make your revenue look unstable to lenders, especially through the transition and adoption of the new principles. Lenders in general, but definitely in the current climate, don't particularly like uncertainty and instability. So what does this mean for borrowing? Let's think of this in terms of borrowing you already have versus potential future borrowing. So you may think that the borrowing you already have is safe, in terms agreed, covenants agreed, right? However, some borrowing is actually more fixed than others. Think of overdrafts, for example. Banks can withdraw or restrict this facility a lot quicker than other credit. If they see gearing getting higher and revenue being unstable, this means credit facilities could change overnight once accounts are made available in the public domain. So that's when you submit those statutory accounts to Companies House. While lenders know this change is coming, the general fear is that they won't make allowances. It relies on them knowing their algorithms, adding that human understanding and interpretation to when the computer spits out that red flag or a no. Lenders in that category are harder and harder to come by nowadays. So covenants on existing borrowing are often hard-coded, meaning that they are linked to gearing, minimum net assets, EBITDA, and interest cover, and you need to be reviewed now to ensure that you don't breach them. So what's the impact on potential borrowing? So increases in EBITDA may potentially make you more attractive. However, a more highly geared balance sheet and deteriorated interest cover will outweigh this. It's likely to reduce your borrowing capabilities and increase the interest rate applicable to you. Interest rates are already rising, so borrowing could get a bit more expensive. The good news is that you can proactively manage this. Prepare for and explain to your lenders in advance. Start preparing now. Model the impact of lease capitalisation and revenue changes. Identify covenant pressure points early. Set clear KPIs as part of your management accounts. Talking of management accounts, adapt the management accounts now to be in line with the new standards. Don't just wait until year end when you're producing those statutory accounts. Talk to your lenders. I know sometimes it's hard to pin them down, but if you think there are going to be breaches arising, I am sure they will speak to you. Review covenant wording. Is it gap frozen or is it moving? Consider whether early adoption helps comparability. Monitor your credit scores. Finally, if you're consistently using overdraft facilities, it's worth considering moving these towards a contracted line of credit, or perhaps even invoice financing to safeguard you against credit that could be immediately pulled should a breach occur. Now, on the flip side of this, something for you to consider is if you offer customer credit, it's important that you consider the impact of this from the other side. Will you consider restricting some customers as a result? What will your approach be?
Thank you, Emily. That certainly highlighted the serious effects that these changes could have on the accounts. Thank you. Maybe you'd be able to tell us how this effect might change remuneration packages, including dividends and bonuses.
Yeah, absolutely. This is often an area that gets a little overlooked when we talk about accounting changes. An impact on dividends and bonuses, because while leases and revenue recognition, they're technical topics, right? The consequences here are real for directors, shareholders and employees when we're talking about dividends and bonuses. At risk of repeating myself here, but let's just quickly run through it. Lease changes, reduced net assets, increased EBITDA, reduced profits in the early years of a lease as straight line rental payments are replaced by depreciation and interest that's front loaded. For revenue recognition, it can have a similar effect. Where revenue is deferred or spread differently over the life of a contract, profits may simply just arrive a bit later than directors are used to seeing. So again, no change in cash, but a change in when profits are recognised and retained earnings are reported, especially in transition periods. So for dividend planning, this creates a real risk because dividends are paid out of distributable reserves, not cash balances. If boards continue to think in terms of historic profit profiles, there's a danger of proposing dividends that aren't actually supported by the distributable reserves. This is where, as with borrowing considerations, ensuring your management accounts are produced under the new standards as soon as possible will mitigate the risk of over-declaration of dividends or incorrect bonus or commission payments. Another area to watch is transition. When these changes are first adopted, there may be a day one adjustment directly to retained earnings. That can reduce headline reserves overnight, which can come as a bit of a surprise if it hasn't been flagged early to the board and the shareholders. So one key takeaway for directors is this: dividend capacity may reduce, at least temporarily, purely because of accounting changes, and that needs proactive management and communication. So let's talk a little bit about bonuses. So bonuses is where it can be even more sensitive. Many bonus schemes are linked to profit before tax, EBITDA, revenue, or earnings per share. Lease accounting can impact EBITDA and profit in the early years. Revenue recognition changes can delay revenue and profit altogether. And the result is that perfectly healthy businesses may suddenly find management are missing targets, or they're hitting them for the wrong reasons, but in later years. This raises two important questions for boards and remuneration committees. First, are your bonus targets still appropriate under the new accounting rules? And second, are we comfortable that bonuses reflect underlying performance rather than just an accounting timing difference? In practice, many organisations are responding by recalibrating those targets, or introducing adjusted or pre-FRS changes metrics, or allowing more discretion in bonus outcomes during the transition period. One way you can look at this is, what do you wish your lenders would consider when taking into account assessing your business for credit? It's kind of the same, but the other way around, for those who are within your bonus schemes. So what's really important here is governance and communication. These accounting changes shouldn't accidentally drive dividend cuts or demotivate management simply because they haven't been factored into existing policies. The best advice is to model the impact early, educate the board clearly, review your dividend policies, review those bonus schemes before the numbers hit the accounts. Handled well, the changes don't need to create disruption, but handled late, they absolutely can.
Thank you, Emily. Well, that makes you think about the timing of things, certainly. So thank you very much. Can I remind everyone, if anything Emily said is making you think, oh gosh, what about X, Y, Z, please just drop a note into the chat. Even if we can't answer now, or we think it's better to answer later, we'll contact you and we can have a one-to-one conversation. So please use that chat function. Right, Emily, could we talk about maybe the impact on corporation tax?
Absolutely. So, as I'm sure many of you will already be aware, reported accounting profits are not always the same as taxable profits. You know that part of the accounts meeting where you've worked out your corporation tax, then you sit in front of your accountants and they go, well, we need to add this back, bring this cost in, carry this element forward, and it brings you to a very different number to what you had estimated it to be. These changes under FRS 102 do not automatically mean an increase in corporation tax. It's the age-old saying, it depends on your scenario. So corporation tax is still calculated from accounting profits adjusted for specific tax rules. And those rules themselves haven't changed. What has changed, though, is the timing and the profit profile. That's where most of the impact lies. So starting with revenue recognition, for some businesses, revenue may now be recognised earlier than before. For others, it could be deferred. Because taxable profits broadly follow the accounts, that directly affects the timing of when corporation tax is paid. The most important tax point here is the transitional adjustment. When a business first adopts the new standard, if prior periods are restated or opening reserves are adjusted, the net transition amount is generally brought into account for tax in full in that first accounting period under the new rules. There's no spreading relief for revenue adjustments. So what might look like a one-off accounting change can translate into a one-off increase in taxable profits and potentially an unexpected tax bill. That can have knock-on effects. For example, triggering quarterly instalment payments for the first time, or restricting the use of carry forward losses once profits exceed 5 million annual allowance. Now for leases, from an accounting perspective, the changes are significant, bringing many leases onto the balance sheet and replacing a straight line rental expense with depreciation and interest. For tax purposes, both the depreciation and the interest are generally allowable. That means the total tax relief over the life of the lease is broadly unchanged, but the timing is different. On transition, this is where leases differ from revenue. HMRC applies a specific spreading rule to lease adjustments. Any transitional debit or credit is spread over the remaining weighted average life of the lease. rather than hitting the tax computation all at once. So a little bit different to the revenue rules. There are wider tax considerations, including changes in reporting interest expense and balance sheet size. While former operating leases should not increase corporate interest restrictions, so CIR, disallowances, any finance leases and any transitional adjustments may affect tax adjusted earnings and CIR capability. And higher gross assets may be relevant for size-based thresholds and reliefs that you may have been available to you previously. So there's a cash flow point here, right? That brings us neatly onto quarterly instalment payments. So this is QIPs, if that's what you hear me saying, because this is where the timing difference is. If we could move on to the next slide, this is where timing differences we've just talked about really come into practice, okay? This is particularly relevant where businesses that already pay corporation tax by quarterly instalments or are actually close to the QIPs thresholds already. Remember that under the associated entity rules, these thresholds are split across associated companies. So for some groups, that means the effective QIP limits are lower than they used to be anyway, bringing more businesses into scope or closer to the line. That in itself is something to keep under regular review. For QIP paying companies, corporation tax isn't just settled after the year end. Instead, it's paid during the accounting period based on estimated taxable profits, not accounting profits. That's why the FRS 102 changes matter. They don't rewrite the tax rules, but they do change when profits show up in accounts and therefore when taxable profits may arise. The impact differs depending on whether we're talking about revenue or leases. Starting with leases, although the accounting profit profile, taxable profits, and therefore instalment payments often remain relatively stable, that's because HMRC spreads the transitional adjustment and in effect smooths over that tax relief over time. However, forecasting becomes more complex. Finance teams need to be very clear on the adjustments between accounting profit and taxable profit when calculating instalments. Otherwise, accounting movements can be mistaken for tax movements. Revenue recognition changes tend to have a much bigger impact when it comes to QIPs. If revenue and therefore taxable profit is deferred until the new rules, instalment payments should reduce. But that only happens if your forecasts are up to date in time. If instalments continue to be paid based on old assumptions, businesses could easily find themselves overpaying tax during the year with a cash flow cost. So equally, if revenue is recognised earlier than before, taxable profits may rise sooner than expected. And if instalment payments aren't increased to reflect that, there's a real risk of underpaying, which could lead to interest charges. The transition year is the point of high risk, particularly for QIPs paying groups. One-off transition adjustments, changes to margins or revised contract profitability can all distort profit forecasts if they haven't been properly modelled. That's why early forecasting, regular instalment reviews, and where appropriate, formal claims to reduce payments are so important in that first year of adoption. So to bring this all together, the FRS 102 changes don't rewrite the corporation tax rules. They don't usually increase the total tax paid over the terms of the lease or over the whole revenue contract, but they do affect reported profits, taxable profit timing, and for QIP paying businesses, the pattern of cash tax payments. Early modelling, clear reconciliation between accounting and tax, proactive management of instalments are key to both avoiding cash flow surprises and those unnecessary interest covers.
Emily, thank you so much. You've been talking for a long time now, so let's move away and give you a chance to get some water. We're going to go to our next poll, please. And this poll, if you could select one answer, which area are you most concerned about managing? Bank covenants and borrowing, profit, dividends or bonus, tax and cash flow timing, not sure yet, but we expect an impact and no concerns. I'm very jealous of the 10% with no concerns. I think it's fluctuating between profit, dividends and bonuses and tax and cash flow timings. But I think we can all say that, having heard from Emily this morning, they all need a bit of thought. So thank you for that. And if we can move back to Jack, please. Jack, we've talked a lot today about judgment. Can you explain why lease length has become such an important issue under the revised standards, please?
Yeah, this has become a really important area of focus under the revised standard, and one which many businesses may want to revisit, even if the leases themselves haven't changed. So, why are lease lengths suddenly now in focus? If we can move to the next slide, please. Under the revised standard, lease length is no longer just a contractual detail, it's a core accounting judgment. It's based on the period for which the business is reasonably certain to use the asset, including optional extension periods where the commercial reality is that the business expects to exercise. That judgment directly drives the size of the right of use asset, the size of the lease liability, and the impact, as Emily's talked about, on the balance sheet metrics and ratios. So decisions that once felt routine now have a visible accounting impact. And why should we review this now? Well, for many, leases have evolved organically over time. I think a fairly typical scenario might be that a lease may have been signed originally with a short contractual term. It's then renewed repeatedly, often on similar terms. And over time, there's a clear commercial expectation that the business will continue to use that space or asset. Historically, that last point didn't really change the accounting income, but under the revised standard, it does. What matters now is whether the lease is reasonably certain to continue, and that requires a conscious assessment rather than just defaulting to how the lease has been treated historically. It's really important to be clear about the message here. This isn't about minimizing liabilities or managing outcomes. Judgments need to reflect the genuine business intent and be supportable. It's about recognizing that some lease arrangements might warrant a fresh look. Some assumptions may no longer reflect how business actually operates, and some leases that have never really been challenged before now deserve a proper conversation. For example, you could ask, does the business realistically have flexibility to exit, or would doing so be commercially or operationally unviable? Are there strategic reasons why certain sites or assets are effectively long-term commitments, even if the legal terms suggest otherwise? These are business questions first, and the accounting then follows. So the key takeaway is this. The revised standard turns lease length into a judgment exercise from a purely administrative one. For many businesses, it will be sensible to review existing lease arrangements and ask whether the assumptions that have been applied historically still make sense, and whether they genuinely reflect the business intent.
Thank you, Jack. That was very interesting. So if we could move on, please, to Emily. Thank you so much for your previous insights, Emily. If we can come back to you and look at the sales team and the operations team and what we also need to consider, because it's not just for the finance team.
Absolutely. So historically, many accounting decisions could be overlaid after the fact by the finance team. Under the revised standard, that's less true. What gets promised to customers, how contracts are structured, and how operational decisions are made now more than ever directly influence revenue timing, profit profiles, and balance sheet positions. So if sales and operations teams aren't aware of the implications, finance teams are left managing the consequences rather than shaping the outcome. So let's take a look at where the impact arises. Let's start with the sales teams. and particularly how customer contracts are put together. Under the updated revenue recognition rules, the key question is no longer when can we invoice, but what exactly have we promised to deliver and when are those promises fulfilled? As Jack's already covered, sales teams are often in control of these customer promises. That means sales teams need to be more conscious of bundled arrangements, goods sold with installation, onboarding, training or support, upfront discounts or incentives, commitments made verbally or inside letters that don't always appear in headline pricing or contracts. Individually, these things feel commercially and operational, right? But collectively, they can have a material effect when revenue and profit are recognised. A contract that looks like a simple sale from a revenue perspective can, under the revised standard, actually contain multiple performance obligations, each with different timing. So the risk is not doing anything wrong. The risk is doing something without realising it has accounting consequences. Or, as covered when I talked about bonuses, and to put into the sales team's languages, contracts that might impact on when they receive their sales commission or their sales bonuses. For operations teams, the biggest area of focus here is leases and ongoing operational commitments. Under the revised standards, lease length is based on how long the business is reasonably certain to use an asset, not just what the contract says. This means operational intent really now matters. If a site, warehouse, piece of equipment is routinely renewed, considered core to operations, or difficult to exit in practice, that expectation feeds directly into the accounting treatment. So operational teams often hold this knowledge, not the finance teams. So without that insight, finance teams may apply assumptions that are technically defensible, but don't actually reflect the commercial reality, which is where the challenge and rework tend to arise later. The common theme here is consistency and communication. Sales and operations don't need to become accountants, but they do need to understand that commercial promises drive revenue timings, operational intent drives lease judgments, and small changes repeated across the business quickly become material. From a practical perspective, what works really well is simple. Flagging non-standard contract terms early. Have a clear place on your CRM system, if you have one, to flag these. Use standard wording wherever possible. Involve finance teams when commercial structures change. And making sure expectations around renewals, extensions are clearly communicated to everybody, including the finance team. Now, done well, this avoids surprises, right? It leads to more predictable profit profiles, fewer awkward year-end conversations, smoother audits, and everyone wants one of those, and better alignment between management accounts and statutory reportings. Now, done badly, finance teams are left explaining volatility after the fact to boards, to lenders, to stakeholders, even where the underlying business hasn't changed. The revised 102 changes bring accounting closer to how the business actually operates. That means sales and operations teams now play a real role in the financial reporting outcomes, whether they realise it or not. The businesses that respond best are those that don't over-engineer the solutions, but those that build awareness, improve that communication, and make sure commercial decisions and accounting outcomes move in step with each other.
Thank you again, Emily. That's really helpful, and to know it's not just on the finance team is really positive, I think. So Emily, could we now move on for businesses that are listening here today who don't have the time or in-house resources to deal with all of these issues themselves? How could we help them?
Of course. So I'll start by talking about the support that we can provide through our financial reporting and our advisory teams. So for many businesses, the challenges with the revised standards isn't understanding that change is coming. It's finding the time and the resource to deal with it properly alongside the day-to-day finance, operations and sales responsibilities. So for our clients that we do not audit, we can support across the full implementation journey, including carrying out an initial impact assessment to identify where the changes will affect your business most, helping you review contracts and lease arrangements to identify judgment areas, assisting with lease calculations and modelling, including transition entries, supporting policy development and documentation, helping ensure disclosures are clear, consistent, and align with your numbers. That support can be tailored depending on where you need help, whether that's end-to-end support or just targeted assistance on specific areas, like, for example, in your leases or just in your revenue, a specific revenue contract that you want to run by us. The aim is to take the pressure off of your internal teams, reduce risk, and make sure the transition is handled efficiently and proportionately.
Thank you. As an auditor, Emily, that was interesting, but I'd like to hear from Jack, if possible, Jack, because Emily has explained how we can support our non-audit clients. Could you briefly explain what support we could give to our audit clients, please?
Absolutely, yeah. I'll just offer a short perspective from an audit point of view, because when you're speaking to your auditor, the nature of the support that can be provided is understandably different. In those cases, the auditor needs to be mindful of independence requirements, which means that they can't take on management's role, perform calculations on your behalf, or make accounting decisions for you. However, this doesn't mean they, or we, if it's us, need to step back completely. What we can do includes things like having early conversations about how the revised standard applies to your business. We can discuss proposed accounting policies and areas of judgment. We can sense check approaches you're considering, and maybe carrying out early or interim stage reviews of transition adjustments, so issues are identified well before the year-end audit. From experience, from speaking to a lot of my clients already, those early discussions are hugely valuable. They reduce the risk of surprises, avoid last-minute work, and make the year-end audit process much smoother. So the key message here is to engage early and communicate. Even a short discussion can help clarify expectations and set the right direction.
Good to hear, Jack. Thank you. So let's go to another poll. It's our final poll of the morning. And the poll question is, what do you see as the biggest barrier to implementing the FRS 102 changes? Time pressure, complexity and judgment involved, lack of internal technical expertise, data availability or systems limitations, and cross-functional coordination. All our multiple answers can be selected here, so please feel free to tick all that apply. But I think the top three, time pressures, complexity and judgments, and lack of internal expertise, are really coming through. And so hopefully that's where you can find your KR support will be able to help you with those three areas. That's a very positive outcome. Okay, can I ask both Emily and Jack to come back, please? We are at the end of our session today, and we can move on to our Q&A. Please, can I remind you to ask any questions in the boxes. Go to the chat box and ask any questions. We will follow up all questions today if we don't get round to your questions now. But we do have a bit of time for some questions. So I'm going to dive straight in and have a look at the questions that have been submitted. If there's any you want to jump in on, please let me know. Maybe Emily, I could start with you. Oliver has asked a question, which I'm sure everybody's thinking. We haven't yet started. Is it too late?
Not at all, but you do need to move quickly. Focus on your key risk areas first. The priority now is to target that impact assessment and early decisions on judgment areas rather than just trying to do everything at once. We can help you accelerate this by support, as we've covered off already. It's definitely not too late. You just need to act now to avoid that rush at year end that sometimes happens when these changes come in.
Thank you. I've got another one here, Jack. Hannah has asked the question, will there be further changes to FRS 102 in the future?
Not too soon, hopefully. FRS 102 is periodically reviewed, so further updates will come, but hopefully less fundamental than these changes. The current direction is continued alignment with IFRS, so building flexible processes now will help manage those future updates. I think the things we might see in the future could be more alignment with IFRS 9, so your financial instruments, expected credit loss models, that type of thing, or the upcoming changes from IFRS 18, which is all about presentation and disclosure of financial statements.
Excellent. And there's another one that might be good for you, Jack. Jill has messaged, do we need new systems for lease calculations, or can we manage this in Excel?
Yeah, so that's a common question, because everyone's thinking about how they manage this process, and the answer really here is it depends on the scale. So smaller or less complex business might be able to manage in structured spreadsheets, but if you've got larger lease portfolios or high volume contracts, then you typically require a system of some kind to keep on top of those large data sets. The most important thing is making sure that the system you put in place is proportionate to your needs, and importantly that it ensures completeness, accuracy, and is auditable.
Thanks, Jack. I guess everyone's concerned at the cost of new software and training on getting that implemented. So knowing you can do this in Excel is good to hear. And Emily, may I ask you a question? Stephen's written in and said, with the changes to lease accounting, when considering corporation tax, you noted that the depreciation and interest is generally allowed. Could you give some examples of when it wouldn't be allowed?
Yes, certainly. Nice to know someone is definitely listening to the detail of what I was saying as well with the generally allowed. So I'll give a couple of examples here. So one is on the vehicle leases. So this is where vehicle has CO2 emissions of higher than 50 grams per kilometre. The usual restriction of 15% still applies here to the depreciation and interest expense. There also may be other components to right of use assets which are not usually deductible anyway. For example, if you pay stamp duty land tax upon entering into a property lease, that SDLT will be added to the right of use asset, but the amortization or depreciation on the component will need to be disallowed. That also goes for other things that would usually be added back because they're classed as a capital expense, capital in nature rather than revenue in nature, and that's like legal fees for setting up those new leases. So it's those kind of things that you need to be looking at. As I sort of said earlier, the tax rules haven't changed. It's more about the sort of profit profile of when you're going to be taxed on it.
Thank you, Emily. Stephen, I hope that answered your question, but if you have any follow-ups, please put them in the chat. Emily, I've got another one that might be good for you. Christopher's written in and said that lenders won't really know the impact on covenants until the annual accounts are submitted, or will they?
That's a fair question, but it does really depend. Okay, so this is where we're talking a lot about making sure management accounts are in line with the new standards, because not just as part of planning for you to assess potential impact, but because management accounts are actually often a requirement by lenders on a monthly or a quarterly basis. This isn't just for loans either. That can also be applicable if you've got large overdraft facilities. Often banks would like to see your management accounts. So it is important that they are aligned. They will require those to be aligned with reporting standards, and large variations to the stat accounts compared to the management accounts will raise those computer red flags to your lenders.
Thank you, Emily. I hope that covered that question, Christopher. I have a very, very good question from Charlotte. Charlotte has asked, and this is definitely one for you, Jack, will our year-end audit take longer because of these changes?
Well, I think the reality is that in the first year, yes, it probably will. For everything that you've had to do in making the initial consideration, the auditors will have to review as well. So the auditors will have more work to do. They'll need to review the new judgments and assumptions. They'll need to test those calculations and models, and they'll need to assess the transition adjustments as well. You can potentially help a little bit with early engagement, sharing workings ahead of the year end, early conversations. They can all help streamline that year end process. As ever, early communication across the audit process is key.
Thank you, Jack. Hopefully all our deadlines will still be met.
Yeah, hopefully. I've just seen another question actually that's come through, just asking about. The question is, and this is from Matthew. He says, "Do we need a formal accounting policy paper for these changes?" So this is something that we're seeing, for our audit clients. I would always advocate for an element of proportionality. So it does depend, but for most businesses, yes, this is a really good idea. A concise but clear policy can really help. And if you're audited, then your auditors are probably going to expect to see something. It doesn't always need to be overly technical, but it should cover all the key judgment areas and the policy choices that have been made.
Thank you, Jack. Managing the process clearly is key. Emily, Carol has written in and said, could this impact how we benchmark ourselves against competitors?
Yeah, that's a really good question, really, because it's especially if adopting timing or interpretation sort of slightly differs. Metrics like EBITDA, margins, and gearing may not be directly comparable during the transition period. But it also might identify if you have differences in your revenue contract with customers, where you may have thought you were initially aligned, but actually, as the new standard means that you have to follow those contracts a little bit more closely. If your profit profile and your revenue profile suddenly looks different to your competitors, might show you're doing something a little bit different.
Absolutely, thank you. Jack, Jane has written, we operate across multiple entities within a group. How do we ensure the changes are applied consistently?
Yeah, so central policy setting is probably the key here. So things you could do would be to start defining your group-wide accounting policies now, make sure that they're in place. You could create standard templates for your contract analysis, make sure they're being used consistently between different accounting teams, and provide that guidance to subsidiaries and the team so that you're all following the same process. Without this, inconsistency can be a problem and can be a big sort of audit and financial reporting issue.
Thank you. I've just read a very big question that's come in from Liam. So hopefully you can answer this one, Jack. How do we determine the appropriate discount rate for lease liabilities?
Excellent. We're getting nicely into the technical detail now. So I'll give a brief summary, but it is a bit technical, this one. So the standard gives you a few choices. You can use the rate implicit in the lease, if you can determine that. You can use what's called the incremental borrowing rate or the obtainable borrowing rate. The difference between those last two is that the incremental borrowing rate, or the IBR, as we would refer to it as, should reflect the specifics of the asset that you're leasing. So the term of the lease, any relevant security, and the wider economic environment and the specifics for your company. In contrast, the OBR, the obtainable borrowing rate, is a simplification that's been introduced by FRS 102, so you won't find it in IFRS 16, which is where this standard's driven from. And the OBR is essentially the rate that you would get if you walked into a bank and asked how much said, and you wanted to borrow an amount equal to the lease that you're you're talking about. So it's the rate you would get from the bank if you just walked in and said, I want to borrow £10,000 because that's the value of your lease. What businesses are doing when they're thinking about their discount rates is they're thinking about developing a framework or a matrix for similar arrangements, which can help simplify things when compared to, say, calculating a bespoke rate for each lease arrangement that you might have in place.
Well, thank you, Jack. That was pretty technical. And if anyone didn't actually sort of catch all of that detail, please speak to your auditors, please speak to your advisors. They will be able to recap. Emily, Mark's asked quite an important question. Could this trigger going concern issues for some businesses?
Yeah, very important question. So in isolation, no, but indirectly, yes. If covenant breaches or perceived weakening of financial metrics occur, it could influence lender behaviour and therefore roll into that going concern assessment.
Of course. And I guess if people are concerned about this, Emily, what should they do?
They should plan early, have those conversations. If there's readers of their financial statements that they know are going to be looking a little bit closer at that impact, have the conversations with them.
And there's a lot of support available. So if anyone is worried about the effect this has on their financial statements, please do drop a note and we will come back to you later. Emily, there's one more here from Jessica. Are there overreaching actions that can be taken to mitigate most of the above?
Absolutely, and I am definitely going to sound like a broken record here. Make sure your management accounts follow the new standard. It's just so important to proactively manage that change, assess the impact, mitigate the risk, have the conversations and the communication that you need to be having sooner rather than later. You know, even if you say you're a December year end and then you wait until 9 months after to file your accounts, you know, that's a long time away before anyone realizes what happens. So please don't wait until that point, because it's too late by then to have the conversations that you need to be having. So management accounts aligning to the new standard is the overarching action, which I'm hoping, because I've said it so many times today, that people take away from this.
Thank you, Emily. I'm sure people have heard you. Jack, I've got one from Lindsay here, who asks, how do we deal with variable consideration under the new revenue model? I guess that's another techie one, but if you could try and explain it for people.
Yeah, so when we talk about variable consideration, we mean things like rebates, performance bonuses, that sort of thing. And these should now be estimated at the contract inception using either the expected value or the most likely outcome. You then include it in revenue only to the extent that it's highly probable it won't reverse. And this constraint is a key one and often requires judgment based on the historical experience and contract specifics. I've just seen another question on revenue which has come through from Jason. So he asks, he's got a law firm with hundreds of contracts and many different clients. Do we need to assess every single case, or can we do a general calculation or method across each department? So it's potentially a complex one, this, but it's safe to say you can adopt a portfolio approach. So where you've got groups of similar contracts, you can look at these and adopt an accounting policy that tracks those. I suppose the key is making sure that those contracts you're grouping are genuinely consistent. So for something like conveyancing, that would more than likely be the case, and it's very reasonable that you would take a view that 90% of those are likely to be successful, and therefore you would recognize revenue on that basis. But yeah, for law firms, professional services firms, this is a really big area. We do we actually have an article on our website. I'd refer you to that as well, but definitely get in touch to discuss that in more detail, because it's a big one for that sector.
Thank you, Jack. I hope that answers both your questions, Lindsay and Jason. But if not, if there are any more follow-ups, please pop them in the chat. Jack, I know no break for you, I'm afraid. Ruth has sent in a message, so hopefully you can answer this one. On the leases, we have a parent company that charges rent to the subsidiary. On consolidation, the rent received and rent paid eliminates currently. Does the change to FRS 102 mean that rent won't be eliminated on consolidation? Is there any specific guidance on the consolidation impact?
Yeah, so again, this is one that I've seen quite commonly already in practice. I would actually take it, you need to go back to first principles on this one and see if there's actually a lease there at all. And what I mean by that is there a legally enforceable contract in place? Because if there isn't, then more than likely these group arrangements are actually outside the scope of the standard. So, you know, you'd need to review that specific example, you know, the circumstances that are relevant to that. But generally, the first step is to look at, is there a contract? Is it legally enforceable? And is there even a lease at all? Because if there isn't, then it's no change.
Thank you, Jack. I mean, we're nearing the end of our session now. May I put you both on the spot, please, and ask you both what you think the key takeaway is? What's the most important thing to take away from today?
I mean, do you really need me to answer that? I will say it again, management accounts. No, it's yes, the management accounts, but also it's just understanding, like we've touched on, it's not just the finance teams that need to be aware of these changes and this implication. So you need to be having conversations with everybody. So your sales, your operations, and your board, your stakeholders. Make sure if you think there are going to be changes that materially impact your accounting statements or their bonuses, their dividends, have the conversations early.
I think from myself, I'll give the auditor's perspective because that's what I am. I think what you need to do, you need to really think about these changes, and you need to document something. Yeah. So if your auditors come in, I think you should have something prepared, ready to have that conversation. If you've got challenges to deal with, then have early conversations with your auditors. There are restrictions like we talked about earlier today, in terms of what we can or cannot provide under our kind of independence constraints, but there is a lot that we can still do to help. We can provide a lot of guidance, we can do lots of sense checking, and really help shape that smooth audit process. So yeah, documentation and communication with your auditors, I think, are both really, really important.
Thank you. And thank you everyone for all your questions, and to our panelists for your insightful answers. Unfortunately, though, we have run out of time today for any further questions. If your question wasn't answered live, rest assured that one of our experts will follow up with you after the webinar. And if there's anything else you'd like to discuss, please leave a note in the pop-up survey at the end and we will be in touch. Please do take a moment to complete our short survey at the end. Your input genuinely helps us shape and improve these webinars and events for you. Lastly, before we go, I wanted to highlight our Finance Focus for Finance Directors webinar coming up in July. This webinar will cover any considerations and planning strategies for finance directors and their teams. Scan the QR code on your screen now to learn more and to book your free place. And finally, whether you're already a client or just joining for the first time to hear about this today, if the discussion has raised any questions or concerns, please don't hesitate to get in touch. We're here to help you navigate these changes and make the best decision for your future. And so I'd like to thank again the panelists and to all of you for joining us today. And I hope you enjoy the rest of your day. Thank you. Goodbye.